Maria, obviously, but those are the key numbers. But again, it's that core month over month and year over year hotter than expected numbers that the Fed is going to look at. Remember, they've got that 2% inflation gauge. Well, this isn't 2%. OK, that's their target. We are not there at all, Maria. Back to you.
Yeah, well, that's right. And it's gotten worse, Cheryl. Markets were going back and forth as you were reporting this news this morning, but we are back negative, down 49 points on the Dow Industrials. These numbers confirm to me that inflation has not peaked. It is worse than expected. Joining us right now to break it all down is former Treasury Department economist David Beckworth, Center Square Investment Management President Scott Crow, a member of the Commerce Committee and Budget Committee, Georgia Congressman Earl Buddy Carter is here, and Fox Business's Dagan McDowell. Let me kick it off right there, Dagan, and get your assessment as markets are worsening in the face of this data, Dagan.
Because the Fed is going to stay on course in terms of raising interest rates, as Jay Powell and company have promised, even if it does mean a recession. Rather than looking at the year-over-year numbers, which is the overall way we and the Federal Reserve read inflation, 4.9% core PCE inflation year over year. Look at the month over month numbers. We have inflation in the United States in August that's getting hotter than it was in the prior month. It was up, core PCE price index for the month was up 0.6%. The prior was just 0.1%. That is much hotter inflation. If you look at the overall PCE index month over month, it was down 0.1% in July. August, up 0.3%. So you had that dip in inflation easing in July because of energy prices coming down, but now again taking off, picking up steam, getting hotter. That is the exact thing that the Federal Reserve does not want to see, and it confirms what we saw in the overall consumer price index as well for last month.
Scott Crow, we were talking about investing and allocating capital in this market and what your expectations are for the fourth quarter. Do you believe inflation has peaked, given these numbers?
I don't think inflation has peaked. I mean, clearly, this, at least the way the Fed looks at it, I mean, this release is going to can make them continue to increase interest rates. If anything, they're going to want to get to 5%. More quickly to get above that 4.7% number that came in on PCE. I do think, though, that one of the things to pay attention to is a lot of the data you're seeing here is somewhat lagged. So the danger is that, on a forward expectation, things are starting to roll over, things are starting to peak. And that by looking at sort of, last month's data, waiting for that to actually roll over, the Fed is, by definition, going to overshoot. I think the bigger impact is just how quickly they have completely changed the paradigm, the investing paradigm. And that volatility, I think, is going to create weaknesses in the economy, like Bank of England, like funding drying up for real estate. I think the speed at which that's occurring and this not very well understood dynamic of quantitative tightening means that the real risk here is you don't just get a recession, but you get a liquidity crunch or financial crisis. Because things do appear to be seizing up. So, other approaches could be to take a longer, slower time to try and deflate this inflation bubble. But that is not what our Fed has told us that they want to do or are going to do.
Well, Congressman Buddy Carter, jump in here, because before we actually figured out that this is a problem that is not going away anytime soon, the Federal Reserve and the Biden administration told us umpteen times that inflation was transitory. Unfortunately, now we're all paying 40% more for a dozen eggs and 20% more for a stick of butter. Across the board, food prices have not come down. Is there anything you and your colleagues can do about it should you get the majority in November?
Well, Maria, first of all, let me begin by sending out thoughts and prayers to all of those who have been impacted by Hurricane Ian and in Florida and Georgia and South Carolina and those in the path. And please be assured that we're going to be with you. Look, with all due respect to crunching the numbers, and I do appreciate this, and I know it is important, what I'm hearing in the district, what people are telling us is that they are hurting, is that grocery prices are too high, gas prices are too high. So what are we going to do about it in the Republican Party? We've got a plan. Our committee commitment to America. We're going to make an America that's strong, an economy that's strong. We're going to cut the spending. We've got to stop sending money out. That is what's causing inflation. Too many dollars chasing after too few products. We've got to address the regulatory process, and most importantly, we've got to unleash American energy. That's what's got us into the mess we're in right now, is this attack on fossil fuels, this war on fossil fuels that the Biden administration started.
Yeah, but at the same time, you've got a bill that's coming to the House today to fund the government so the government doesn't go have to shut down. And in that bill is money for Ukraine. In that bill is other money elsewhere. I mean, this is not what the administration is doing, what you're saying. And by the way, where does this rail strike stand? Because the president told us that there's a tentative agreement, but we haven't heard a word from the rail unions. Did he just put a pin in it until after the election so that nobody understands the incredible impact a strike from the freight workers would have on an economy that's already weak?
And thank you for mentioning that. This would be devastating if we had a strike by the freight, by the railroads, and no question about that. And yes, I do question whether they have got this resolved or whether it's just a temporary fix or what. But one thing's for sure: if this happens, this will devastate our economy because it's already it's already in jeopardy as it is, and this would be the tipping point for it. No question about that.
And here we are in the final day of the third quarter, Cheryl. You've got more data coming out now. Any indication of what the fourth quarter looks like?
Well, this is more. I was digging into what you were talking to Congressman Carter. Look, if you dig into that spending increase, that was a hotter than expected number at 0.4%. Listen to where the spending was. This goes to his point about what he's seeing in his district. Housing, utilities, transportation, and health care. That spending number jumped on basic necessities and more spending on those basic necessities. You know, that's exactly in line with what he's saying that his constituents are dealing with, that Americans are dealing with right now.
Well, these are the essentials, okay? These are the essentials: food, fuel, shelter. These are the essentials that have skyrocketed in price. And David Beckworth, a lot of people want to say, well, oil prices are down from the highs. That's good news. But the reason that they're down from the highs is because of slowing demand, a slowing economy. Not what you want to see. We just got the GDP confirming that we are in recession, 2 quarters of contraction.
Yes, and I think the reason we care about the core number, the core number used to be made fun of, as you recall. Why do we look at core inflation? But it takes out those commodity prices, energy prices, which are falling. And it's showing us that services, these core parts of the economy, that inflation is indeed growing. And that's the hardest part to get rid of in terms of inflation. I would also note this doesn't bode well for the global economy. This is a signal to the Fed to keep tightening. And as we see, other central banks around the world are following suit because they have to keep up with the Fed, the dollar. So this inflation report is a challenge not only for us, but for Europe, for Bank of England, Bank of Japan as well.
Yeah, exactly. So what do you think is going to be the case in the fourth quarter and 2023 then, David? Are you in the camp that we're going to see a dire decline and a recession that is long and deep, the way that Ray Dalio, Larry Summers, Jamie Dimon seem to be predicting?
Well, I'm hopeful it won't be deep and long. And if we look at the bond market's projection of inflation expectations, they have inflation going down over the next few years, which would mean the Fed could ease up. So my hope is we do have a mild recession, but we should probably plan for the worst.
And how do you plan for the worst? I mean, what are you doing in terms of preparation? Let me get your thoughts on that, Scott Crow, in terms of preparing for these curveballs that no doubt are coming at us.
Yeah, I mean, I think, unfortunately, a soft landing is overly optimistic. I mean, I wish it was going to be true, but I think once we're already there in terms of having a recession, and again, the fact that it's likely to be accompanied by a liquidity crunch or some kind of financial crisis, as we get, as the previous speaker highlighted, these wild swings in currencies that are putting pressures on all kinds of the financial system, I think that the correction is likely to be, pretty significant. And depending on whether we get a financial crisis alongside it, could be long or could be short. I think the way that you navigate is through the word caution at this point. I mean, on the one hand, we're much closer to the bottom here than the top. There's a lot that has come off, but I think we're in that phase of the market where you will start seeing more things break. You will see a little bit of panic, and that actually will be the sign that we're getting towards the bottom, because I also think that will be a sign to the Fed and other setters of monetary policy that maybe they've gone too far, and then they can pause and move off. And so that would be the narrative I would be looking for to unfold, and looking for areas to invest where you see resiliency and good valuations. I mean, we focus at Center Square on real estate. We really like rental residential. Companies like Equity Residential, ticker EQR, or Invitation Homes. These are companies that are benefiting from the fact that housing is as unaffordable as it's been since 2006, and people have to live somewhere. But also assets that will be very resilient in a downturn. Make sure the other area to focus on, I think, for any investor is leverage, making sure that the companies are.
Yep. Yeah, it's a great point on leverage. Thank you for making that point, Scott. Dagan, jump in here.
When Scott's talking about the kind of financial crisis brewing and what the Bank of England had to do, reversing course in terms of tightening and diving into their bond market to prop that up, the thing that triggered it was, again, when the tide starts going out, you get to see who was swimming naked. And it was pension funds in the United Kingdom employing this, what's called a liability-driven investment strategy, which involves leverage. So so be it. The central banks have to kind of ease the financial conditions, but this is the price you pay for reckless behavior, for financial engineering and shenanigans. And investors are very quick to start rubbing their hands together and anticipating more monetary stimulus from all of these central banks because they've become so used to it. It's like a little bit of pain, let the Federal Reserve dive back in and prop up the leveraged rich or institutional investors. It's not going to happen again. Really quickly, Nick Timmeros on Twitter before the number came out pointed this out. And if you look at the 2-year Treasury yield, it's at 4.17. It's down a slight amount right before the number came out, and the 10-year yield down a slight amount. Not much movement in those numbers. And he pointed out, for what it's worth, the core PCE inflation numbers released this morning, they were likely to show a sizable increase, as we saw in August from July. But the Fed already knew this at its meeting. This would have been known to the Fed at last week's meeting based on the CPI and the PPI. So this is not news to the Fed and not really news to the markets. But if you want to talk about investment strategy, you can get more than 4% putting your money, earning more than 4% on a 2-year Treasury right now. If you think that the Fed's going to fight inflation and inflation is going to come back below 4%, you'll make money in that. You'll make money. You'll have a real return in that over 2 years if you think inflation's coming down.
Well, Buddy Carter, we're talking about the stimulus from the Federal Reserve. We cannot forget the stimulus coming out of the federal government and the fact that even with 40-year high inflation, this president continues to throw more money out there. How about this student loan bailout? Estimates call for the cost of that to be anywhere from $500 billion to $1 trillion. So it's adding to the debt and deficits, but it's not even moral. You're picking and choosing whose debt you're going to forgive.
There's no question about it. This administration is so tone deaf. They're so out of touch. This president is living in the past. He has no grasp of the present, and he has no solutions, no plans at all for the future. And that is the combination that has led us to where we're at right now. To Dagan's point, we have experienced financial insanity in this country. That's why we've got to stop the spending. It's estimated the American Rescue Plan added almost 4 percentage points to the inflation inflation rate alone. And now this Inflation Reduction Act, which I refer to as the Inflation Acceleration Act, it's only going to do worse. It's adding fuel to the fire. When will they understand that you cannot spin your way out of inflation, that you cannot spin your way out of a recession? And we are in a recession. I don't care what they say. I don't care how they spend it. When I'm in the district, when I'm talking to the people in the district, they're concerned. They're hurting. They're looking for solutions here. They're looking for some relief. And I had a roundtable with farmers just recently who told me, get ready, because the crops that are in the ground right now that we're going to be harvesting, those prices are going to be even higher.
Well, you know, one of the issues with the hurricane is the crop damage, right, Congressman? I mean, we've seen futures for orange juice go higher and other crops because there are worries that there was severe crop damage in Florida. We know that Hurricane Ian is now headed toward Georgia, South Carolina. What are you doing and the people of Georgia doing to prepare for this Category 1 hurricane now, which has re-strengthened?
Well, certainly we are prepared. This is not our first rodeo. We're used to this, and people understand what you got to do. You got to plan ahead. You got to check on your neighbors, your loved ones, your pets. You got to have your go kits. You got to have your water, your food, your flashlights, all of those things. But most importantly, you got to follow the directions that SEMA, that GEMA gives us. All of these are extremely important. Fortunately, our governor, Brian Kemp, has already declared a state of emergency. So we're ready as we can be and prepared as we can be. But I'm telling you, these things are so unpredictable. And yes, the after effects that we're going to see on our crops is going to be devastating.
Oh, gosh. And that will only keep inflation elevated. David Beckworth, let me come back to you and get your solutions. If you do believe we're going into a weakened period on the macroeconomy story, how do you protect yourself? What are you telling clients to do should the worst case scenario play out?
Well, let me first just step back. I think what we're in is a situation where the Fed is raising rates because of inflation. And I think it will raise rates until something breaks. What we saw in the UK is the first sign that something in the financial system is about to break. What we really want to see for a recession, though, is the other shoe to drop, and that's the labor market. It has been remarkably resilient. You know, the past few months, over this whole year, they've been averaging over 400,000 jobs a month. Job openings are still wide open. So it will be interesting to see what happens to the labor market as we go to this fourth quarter. You know, as reported in today's report, we have had robust spending still too. So spending, labor markets, those things probably will turn around going forward, and I think that will be interesting to watch.
And in terms of allocating capital in this environment, where do you want to be?
Well, I think what the previous speaker shared, I think, is good advice. And again, just watch what the Fed is doing and where inflation is going.
Yeah, Scott Crow, we got a market that is flat. Dagan says this is not new information for the markets or the Federal Reserve. What are you going to be looking at in the coming weeks? The third quarter earnings reporting season is going to begin in about 2 weeks. Do you think we'll see a profits recession?
Well, we already are seeing some downgrades, but it's a very difficult time right now. We're in a
Dagan, we know that Stephanie Pomboy has predicted this profits recession for a long time. Mm-hmm. Estimates have not even come down to the extent that she thinks they should be. So I'm wondering if we're in for some rocky road in terms of the markets for the fourth quarter.
And you brought up at the beginning of the show what happened with FedEx and FedEx stock. I think that was a flare into the sky for investors that people, many investors have completely misread what is going on, not just in the U.S. economy, but the global economy. You have the Europe flat on its back in an energy crisis. And now you saw what happened with the Bank of England, the central bank there on Monday. And it's going to take, readjusting the thinking about what the impact of all this tightening is. In this sense that, and I raised it the other day, investors have, the buy on the dip mentality related to how central banks behave has been present for, I'd say, at least a couple of decades. But they were so much quicker to, I'm not going to wait for a 50% drop or a 40% drop in markets. I'm getting in after 20 because the central banks are going to come right back in and lift my assets and lift all boats. And I think you're just beginning to see that mentality break down. You saw it, the rally in the summer was driven by this idea, and the rally, again, you jump right back in on Tuesday when the Bank of England intervened, and maybe that is finally ending, but it's going to take a lot of time to kind of break that mania.
Yeah, and we're seeing right now the pre-announcement season. That's why we're hearing from Nike talking about all that inventory. Inventory's up 65% at Nike. That has the stock down this morning, one of the real movers of the morning. For the month of September, the Dow is down 7.25%. The NASDAQ is down better than 9%, and the S&P 500 down 8%. When you're looking at allocating capital in a market that is this nervous, Scott, are there any areas to hide?
I would be very cautious. I think there's, in the short term, there's a good opportunity for a little bear market rally here. Now we're at quarter end, and it's been a very volatile September, but I don't think this is over. I think you want to be picking your spots. I think you want to be avoiding companies that don't have free cash flow, that have high leverage, and looking for areas of resiliency. Dagan's suggestion of buying government and corporate bonds in the 4, 5, 6% level, not a bad place to be. I think you weather the storm over the next couple of quarters. I do think that the silver lining on the notion that this liquidity crunch is going to see something break, these wild swings are going to see more things break. The silver lining is that will be a dose of cold water onto the Federal Reserves to maybe back off. And which I think would help the markets, help the outlook for the economy, and really take out the downside tail risk that is building.
Well, look, tonight the House is expected to pass its continuing resolution, Congressman Carter, and then the House leaving for the midterms. When you all come back on November 14th, it'll be the lame duck session. It's going to be all about the midterms after this. The government will get funded, you think, because you're in the minority. Even if you vote no, it's going to go through. And we've got the September jobs report next week, next Friday. That'll give us an indication of whether or not all of this inflation and weakness in the macro story is, in fact, hitting jobs. What will you be focused on?
Well, certainly, as you pointed out, I will be voting no on that CR today. We're kicking the can down the road till December the 16th to the lame duck session, and then we'll see what the majority party does then. But another example of fiscal irresponsibility on the part of the majority party right now, the Democrats. And I might add, Maria, that is one of the reasons why I'm running for chairman of the Budget Committee next year, is to bring some financial sanity, some financial responsibility to this government, and we need that. The taxpayers have been mugged, and we've got to stop this corruption that exists in our federal government, and particularly in our budget. That is extremely important. But we are going to address this. We are ready. And one other thing I need to mention is that I don't think that we can ignore the drop in the stock market as the administration wants to try to do. It has dropped almost 20%. I don't know about y'all, but when I get my statements in from my retirement now, I just put them straight in the file cabinet. I don't even look at them. I don't want to see that.
Well, the NASDAQ's actually down 30%, so some areas of the market's even worse than that. But, Congressman, I want to ask you your thoughts on what happens on December 16th. Let's assume the continuing resolution passes tonight in the House and the government is funded until December 16th. Then do the Democrats take up the National Defense Authorization Act, and do they jam the NDAA with more spending and, their commitments to the green economy? Is that what the plan is here?
I suspect that is what the plan is. On their way out the door, I'm sure they will try to spend as much money as they can. And, yes, they will try to jam us. And the CR is going to pass tonight. They have the votes.
Yeah, yeah, I assume so.
It's going to pass without Republican support. I can assure you of that.
Right, right. David Beckworth, does policy matter to investors at this point? All of this spending obviously has stoked inflation to 40-year highs, so you got to pay attention to it. But are investors focused on what happens toward year end and the midterm elections? Will that be a catalyst for this market?
I think it will. If you look back this past week in Europe and at the UK, one of the triggers there, they had the pension problems as mentioned, but one of the triggers was a massive tax cut and the concern about a big budget deficit that caused the bond vigilantes to come to life and to go after the Treasury, UK government bond market. So I do think there is concern, and we might awaken the bond vigilantes here too if we're not careful.
Yeah, and in terms of this CR, does the market, do you think that the funding, including money for Ukraine, a couple of other areas, no money for the border? We've been talking about the fact that Kevin McCarthy says he's not voting yes on this because there's absolutely not a penny for the wide open border, and we're finding terrorists and illicit drugs coming over.
Well, so far, the bond market hasn't been too worried about the inflation expectations that flow from that. Mm-hmm. If you look at like 5-year break-even inflation rates, they have actually been dropping quite a bit. Now, some of that's due to commodity prices, the softening of the economy, but we have yet to see evidence that the bond market is overly worried about it. They may in principle be worried about it, but I'm not sure they're yet worried to the point that they're going to start raising their compensation they want for inflation.
Yeah, Dagan, you're the final word here. The market has stabilized up just a fraction after that sharp sell-off yesterday. Looks like we'll get a fractionally higher opening this morning.
I guess any gains that you'll take them at this point, but there are tough days and weeks and months ahead for the market and the U.S. economy, because it will be a year and a half before we feel the pain of what the Federal Reserve has done in raising interest rates.
Yeah, it's going to be a long time before we get out of this, this pickle that we're in now. Dagan McDowell, Scott Crow, David Beckworth, and Congressman Buddy Carter, Cheryl Casoni, thank you all. A reminder, if you'd like to donate for Hurricane Ian relief efforts, visit redcross.org/FoxForward. Varney & Company picks it up.